Before we jump right in, I have a few housekeeping rules. And first and foremost, welcome from Allraise. I am Marian Arake. I'm leading digital events at Allraise. And so really pleased to see you all here and joining us today. Before we do jump in, I want to go over a few housekeeping items. So pointing out a few features on the webinar, you can use the use the chat function to introduce yourself to others on the call. And if you do have a question for Judy throughout the call, please put it in the Q&A box and I will try to elicit those as they come through. For those coming in, yes, this will be a recorded session and you will have access to it on the Allraise website, if not by tomorrow, early next week. And just to go over the agenda, we do the welcome. Judy's going to talk about for 40 to 45 minutes, and then we'll close out with Q&A from you all. So again, leveraging the Q&A box for those questions. And if questions do come up during the session, please feel free to drop them in, and I'll definitely let Judy know what those are, and then we'll close out. And without further ado, welcome to all of those who are trickling in. And yes, so Judy is our speaker today, and she has been building and investing in SaaS companies since 2000, when she was recruited to Salesforce as one of the original product managers. This includes 7 early years at Salesforce, 7 years consulting exclusively with B2B SaaS companies, and 4 years building a VC firm that invests in early stage SaaS companies. As a consultant, Judy has helped 30+ SaaS companies develop their go-to-market strategies and was acting CMO for companies including Zora, ServiceMax, and Conga. As an investor, Judy led productive investment strategies and advised portfolio companies as a board member and observer. With Valia Ventures, Judy is selecting, advising, and investing in a new portfolio of successful early-stage SaaS companies. So without further ado, Judy, I will roll it over to you, and welcome to everyone who has joined us.
Thank you so much. And I'm really excited to be sharing this content with this group, because I actually created this content a few years ago, specifically with women founders and women investors in mind. As Marian mentioned, my entire background is in enterprise software, and for the past 20 years with cloud business software specifically, and in roles across product, marketing, partnerships, consulting. And then I started moving from an operator role to a venture investor role back in 2013. So I'm gonna let you guys look at the agenda while I tell you why I created this. And it's because when I did move into venture, it's very straightforward what everyone means by market sizing. We know why we need to do it, but it's really hard to find concrete answers and examples out there. And so I started asking around, and I received, when I was ready to dive in and do some bottoms-up market sizing for some companies I was evaluating, I received answers ranging from, oh, I can't share that spreadsheet with you, it's really confidential, which I thought, wow, God, it must be rocket science, and it's so confidential. And then I also received answers of, oh, don't worry, Judy, Pat, you'll develop a sense of it over the next couple of years in venture. To which I thought that was completely not helpful. And I didn't understand how market sizing was something we developed a sense for. It seems like it should be a more concrete thing, which it is. So what I realize now is a lot of those people who I think I was asking, they didn't have examples. They weren't proud of their examples to share. And they didn't know themselves. So there's a lot of hand waving and half answers that I've heard founders get, and that I received even when I was on the investing side. And so once I pulled at the threads and figured it out, it is a very straightforward process. It is just data and logic. And so I want to break down this and share this framework with you so that all the women founders in the room or on this call can have a lot of confidence in the logic they used and the answer they get to make the decisions on what's best for your business. And also, if you are asked by venture, have a very, very confident answer and very defensible answer. And equally for the women investors on the call, to feel very confident that you've done a very rigorous process for your bottoms-up market sizing for any deal you're evaluating or recommending for investment. So let's jump in. So, this audience I usually give to either women investors or women founders. This time I'm giving it to both at the same time. So the you, I'll say you a lot, and it's really both. You both need to do it. So here I'll work first and foremost for the CEOs. For the founders on the call, you have to really do the bottom-up market sizing because it forces you to get very specific and quantify your market, which then by doing that work helps you prioritize which segments to focus on first for your go-to-market. Even most importantly, it helps you really crystallize your product roadmap and which products and features are most important for which segments you're going for. So you can align your go-to-market and your product strategy around these realistic segments and the different opportunities in each. It helps you right-size your pricing and packaging for the different segments you're going after. And ultimately, understanding your market size helps you understand whether or not your company is a good fit for venture or not. So it's really your market size and your structure that shape everything. So it's not just the number. Somebody might come in and say, I have a $10 billion market size, market potential. Great. Well, if say that hypothetically that 10 billion were made up of selling your product to two companies, say Amazon and Microsoft, the density of selling, a $10 billion market to two companies, that's just not a thing. So that would not be a good fit, even though like the 10 billion number might sound fantastic. So it's really a combination of your market size and the structure of that market that need to be thought of together as you're thinking about your product strategy, your go-to-market strategy, and your financing strategy. So the short answer, and this is Judy's opinion, is that for a B2B SaaS company, and that includes a B2B AI product or a B2B enterprise technology product with a recurring revenue model, is $5 billion a year for the market size. I know a lot of conventional wisdom out there is 1 billion, and I just don't think that's big enough for venture to seriously invest in, and will lead to a lot of wasted time for CEOs trying to have those conversations. And really it comes down to the market size isn't big enough. So you have to, and what drives this, you have to realize, is the investor's perspective. It's not anything. So what I'm not saying is that anything under a $5 billion market is a bad business. There are amazing businesses and companies built selling to companies with less than $5 billion markets. But if you're trying to figure out if you're a good fit for venture, or if you're an investor deciding whether or not you should invest in a company, I say 5 billion because venture only invests in markets that are big enough to support one or more publicly traded companies with the ability to grow. So the market has to be big enough for one or more company to get to 100 and 120 million in revenue a year and keep growing from there. And then you also have to think about it from once you're on the venture track, picture a Series C or a Series D company writing a check, years from now for $50 million into your business. Into writing a check for $50 million into a $1 billion market. I don't see that happening. It's not going to happen. So when I say that $5 billion market is the minimum, it's because you're thinking about venture for the whole process, not just whether or not you can raise your initial seed. I think there are plenty of seed firms and pre-seed firms especially, and definitely angel investors who will invest in markets way smaller than 5 billion. But that doesn't mean you're set up for success downstream. In fact, you could be super successful and achieve all the goals and downstream still hit a financing wall because of your market size. Okay, now, I don't believe that venture financing is the end all be all. It's very, very important that this doesn't come across as if your market's not 5 billion and you're not venture backable, your business sucks, because that is absolutely not true. And if I ever have an idea for this killer software product that I want to build, I hope that it's in a $999 million annual market, just under $1 billion, because then I don't have to deal with venture and none of my competitors can raise venture either. And it comes down to a quality and an execution race. That being said, but if you are in a market that is big enough for venture, at some point, and if it's a good market, at some point your competitors will raise. So then you will be in a situation of, likely having the oxygen sucked out of the market by your competitors who now have so much money to drown the airwaves. So venture is not the end all be all. There are lots of other very successful businesses that get to have the last laugh without venture. But it's a tough consideration for all sides. So I want to talk first about tops down market sizing, because it's what most people do. And it's something you should still do. So I always tell both investors and founders to look at it from both a top-down market sizing and a bottoms-up market sizing approach. So tops down is either you're selling a software product in an existing category, or someone at Gartner or IDC or Forrester have already done the work for you, and you can get that report or the press release about that report and say, wow, my market is $6 billion according to Gartner. Great. Get that, grab that, claim that. But even if you had multiple analyst reports saying that you're in this huge, big ass market, I still recommend you do the bottoms up market sizing, because there's so much other benefit you'll get out of it. So many other insights into your business strategy. So tops down might be an analyst report, or it might be taking another existing software market and then doing a swag. So it might be, the software market for ERP is this big, and we're doing analytics for ERP, so that's 10% of the market. And you could go and say, yeah, 10% of the market, companies that buy that would buy this. So therefore, that's our market size. And that's a great example of a tops down. If you're selling more of an SMB product, it might be, there are 1 million companies out there and they could all be our customers. Okay, great and true, but still so not specific that it's not actionable. And that's the problem. So instead of taking the relying on only the tops down approach, which is just less credible because they're such big assumptions and makes investors, like when I was on the investor side, I would just be like, yeah, sure. And, I would try to get my eyes forward as they were also rolling in my head. And so instead, what's much more credible and concrete is a bottoms up approach, which so many reasons you should do it this way. First, VCs are likely doing it this way. They should be. And you need to at least understand their thought process in this. And it also just lets you have way more granular assumptions and be much more precise and get a lot out of it for yourself. So what I want to do is walk through 3 different examples of bottoms-up market sizing. And yeah, we'll go from here. So first and foremost, the definitions. Take screenshots. These are this stuff is all Googleable. Well, almost all of it is Google. The definitions are all Googleable. The US target addressable market. That's all the companies in the United States that fall into your market. How many companies are there? Times annual contract value. How much would they pay you? So if it's $1 million and they would all pay you $1 million. So I'm focusing. So first and foremost, you can focus on US company estimates. And that is because that's the easiest data for us to get. We have the census, we have the Bureau of Labor and Statistics, we have lots of different business trade organizations that are counting their members and breaking down, the manufacturers by size and by region in the country. So we have a shot at finding the data we need based on US companies. Now, US SAM is the US serviceable addressable market. It's just taking your total, your TAM, times some and giving it a haircut. That's all you're doing. You're giving it a little bit of a haircut in the US for what percentage of those companies can you actually get to. It doesn't mean you're going to win. This isn't your win rate. This isn't how many companies you will have. Still, nothing about you. The only thing about you here is the annual contract value. But it's how many of them could you get to? If you're trying to sell to, an off-the-grid somebody up in Alaska, you probably can't get to them. They're off the grid and you're not going to travel to Alaska to go sell to them. It's an extreme example. So, as a default, you could use 90% or even 95% for the serviceability in the US. But it just forces you to think realistically about how many of these companies can I get to? And there often are differences by segment. Now, like I said, all these definitions are available on the internet. The thing that drove me the most crazy when I was trying to figure this out as an investor was this global multiplier. Because yeah, we can find all this data in the US, but finding that information for how many similar companies and what's their structure breakdown in Brazil or Indonesia or Portugal, that information, like, you can't do that for every country. Well, it turns out venture as a whole accepts a ×3 multiple. So simply do your logic for the US numbers and then times it by 3, right? So we're gonna go through some examples. I wanted to share this. When I heard that ×3, I was ready to pull my hair out because I'm like, it's that simple, and it is. Like, I tell everybody ×3 is the hardest math in this process because it's hard to get that answer. So here's an example. Let's just say this is a software selling, a company selling software to dental offices. And so, I'm using a straightforward example, and I can talk about more complex examples. We can find out how many dental offices there are in the US and some sort of employee or office location breakdown. So we get to, I know that we want to see it by small, medium, large, and extra large. Now, whether or not small is defined based on whether or not these sizes are based on number of employees or their revenue or their number of locations, that matters less. That depends on how the data is available, right? You might ideally want it based on number of employees, but all you can find is number of dental offices. So that's fine. You can figure out, look at the data that you get and draw the lines and determine what you consider small, medium, large, or extra large. So you find the number of offices in the US, and then you think to yourself, based on the software we're building and the value it's providing, and think through the pricing, how much would most medium firms pay us? Okay, here in this example, I'm saying they would pay $60,000 a year for this software. So that means the US TAM for the medium size segment is $3 billion a year. Now, using I'm gonna call it generic serviceability haircut, and we could sell to 90% of them. I think in the US, it's actually very reasonable to say you could sell to 95% of them, even 98. But anytime you're doing market sizing or going and talking about how great your potential members are, everyone always gives them a haircut anyway. So this is just a way of talking about how much that haircut should be. So that gets you to an initial US serviceable addressable market of 2.7 billion. Now, let's just use the simple ×3 multiple, 50,000 companies in the US, 150,000 in the rest of the world, or globally. Now here's where ×3 is the default accepted assumption for the global multiple. There was a case where there was one company I was evaluating an investment in where we really could justify a ×5 global multiple because of the breakdown of how the product was, what the product was, who could use it, and the fact that the US was not representative of 1/3 of their market. It really was only 1/5. So you just have to be able, this framework just gives us a way to really think through each assumption and be able to justify it and be able to make a change when you're actually in a conversation about your market sizing with somebody. You could then change it, and like in this case, I could easily see, of course there are more dental firms in the rest of the world. But, so this is also being very conservative. So this would be a $9 billion TAM just for this segment. And then let's assume that, well, now it's a SaaS software solution, but we're probably not gonna have sales reps in every country for a long time, never in every country. But could this medium segment still sign up and use it on their own? Yes. So, this is now thinking through how much of the rest of the world's market is serviceable, that can you eventually reach and get to. So here for the mediums, I said 70% globally, but for the extra large firms, I said we could probably only get to 10%. And this is a semi-hypothetical example, so I'm not an expert on the dental software market. So don't take this as sample data, not as real data on this market. But for this example, my assumption there is that there are going to be a lot of state-owned dental firms and dental health clinics. And so in other countries with better state-run healthcare, we may not be able to sell our dental practice software into those mega state-run organizations. So this is just an example.
Judy, we have a few questions.
Okay.
The first one being, what if your TAM is truly huge? Does that inspire skepticism? In our case, we are doing credentials, which encompasses almost every kind of personal data from ID to student transcripts.
Yes. So the huge, ginormous market sizes absolutely invite skepticism, but doesn't mean you can't shut that down or shut them up quickly, right? By sharing a spreadsheet like this. So picture in this example I've taken, in order to make it fit on a slide, I've shown just dental offices, small, medium, large, extra large. If you're building and selling a product that can be sold across lots of industries, to small, medium, and large in all of those industries, this spreadsheet would have, a lot more rows so that it would actually have, let's say, financial services, extra large, large, medium, small, healthcare, extra large, large, medium, small, education, you could have all this. I've done this with a founder once, and our spreadsheet was about 100 rows, right? But what that allows you to do is think about the nuance of like, well, financial services and healthcare would actually probably pay us more annual contract value each year because they need to have the HIPAA or the FINRA compliant editions of our product, while, let me think of another industry, other industries don't need those HIPAA or FINRA compliant versions and would be on a lower priced edition, and their average contract price would be a bit lower. So it allows you to really be more granular in your assumptions and thinking about the differences between each segment, as well as any serviceability differences. But I recommend, I literally did this just to fit it on the slide. I recommend really thinking through, going out and getting the US data that you can for that. And then where you show, oh gosh, I know that then you're getting to show and think through yourself a particular industry. Maybe it's healthcare. Maybe healthcare is going to be extra hard to sell to, so you give yourself a 50% US serviceability for the healthcare market, for the large and extra large, or for all of them. You are building up a very defensible proof of your big ass market size.
All right, and then just one more question and then we'll continue with this. How do you determine what the initial ACV is?
So the initial ACV, so annual contract value, is the price a company would pay you for your solution. So this comes down to your pricing. Like how do you price your product? How much do customers pay? So this isn't the same, like you don't have to, you probably have a couple different price points. Maybe a free, maybe a cheap, maybe a medium, maybe a big. You have different price points. So this isn't, you don't have to incorporate all your pricing in here because this isn't down to the customer level. This is about the market segment. How much on average would they pay you in total? Whether it's based on users, based on usage, based on whatever the pricing X factor is for your product. It's how much on average would that customer pay you a year? And that's actually a really good segue for the next slide, because I'm going to talk about, I think on the next slide. Let me go to the next slide and I'll tie this in. So here's an example, a bit zoomed up because I'm focusing only on the US SAM right now. Now that we all know you just have to ×3 to add in those other spreadsheets. So in this case, this is a bottom set market sizing. Let's say healthcare. Selling to, and once again, made up numbers, selling to healthcare companies. Now, well, here's a bad example. Selling to manufacturers. So selling to manufacturers. Now, and this is broken down by the size by number of employees. So it's just, however you can get the data to break out your small, medium, large. And it doesn't, in this case, if I can get the data is available in 5 segments, great, more is better. There's no reason to compress this into small, medium, large. Keep it how it's provided. Now, for this annual contract value, say you are an enterprise technology company or a vertical SaaS technology company, and you your product is this big today and it offers real value. And so this ACV is how much will they pay you, this year or next year. What I always recommend then is doing the spreadsheet, doing the research, and having this be the initial or first year ACV, and then clone that spreadsheet to the next one and do it again for, God, but we know how much more we're building to our product. And when we add all these additional capabilities and great power, customers will be paying us 3 times as much in 3 to 5 years. So then do the spreadsheet with this year's effectively value, how much they'll pay each year, and then do it again for how much you think they'll be paying you in 3 to 5 years, because you don't need to be so punitive on your market sizing. It's not, just on the exact product as it is today. If you know you have a powerful roadmap that's going to get customers paying more in the future. So a few things just to talk through on this example is, in this example, there's a big difference in what a 1 to 9 person company will pay you a year versus a 500 plus company will pay you a year. But there's also a huge difference in how many companies there are, right? So 150,000 versus 5,000 at most. And the serviceability also comes down a lot to what your product is. So is your product appropriate? Can it really be used by the tiny companies? If it can't, if it just requires a level of sophistication that they don't have, then don't fool yourself and call this 90%, right? If it really takes a sophisticated user to use your product, then be honest about that. Oh, this is the most important thing. Every founder on this call should be doing this bottoms-up market sizing for yourself. Do it for yourself. There is no value to yourself or anyone to inflate or adjust or inflate any of these numbers. You need to know first and foremost for yourself where the biggest opportunity is. If I were to make this 90% serviceable up here, this market would look great, right? But or would look better, and it could shift your focus. So this is first and foremost for yourselves. Whether or not you share it with anybody, that's a separate question. But do it for yourself uninflated. I have one more example. And if there's any questions, just toss them out.
Oh, yes, there are questions. Sorry, let me make sure you said that one. Do any of the market sizing tactics apply similarly to B2C companies? For example, the 3 times global multiplier.
Great question. I meant to address B2C up front. My answer is I don't know. I am woefully uninformed on all things B2C. What I hope for anybody who's a B2C founder on this call, what you can take away from it is the methodical nature of this and figuring out the same methodical structure for B2C. But as far as what the multiple is for B2C, I don't know. Or what the minimum market size is it 5 billion for B2C? I don't know. So this is definitely for, B2B technology, but I think taking a rigorous approach to market sizing and then at least isolates the questions you need to track down for the B2C side. Thank you for asking that.
Mm-hmm. Okay,
here's one more example. And once again, I'm only showing the US. Obviously, you would add the global. In this example, I think it was like a real estate software, a company selling software to realtors. And the software, or the solution, whatever it was, created this really amazing, high quality imaging for the inside of a house that was really valuable for like really high-end homes. It really helped market high-end homes that were for sale. And so in this example, like founders were initially really excited because there were so many realtors in the US, right? There were 2 million realtors and they would all pay $100 a month for this. And so you can imagine that it seemed like it would be a huge market, but But this is where it comes down to the nature of your product and who will really buy it. And so I call this like the sweet spot approach. Like you have, in a lot of cases, it's not credible to say every realtor will buy it. Like I had a neighbor who was a realtor and she sold at most one house a year and it was not a mansion. So she was never going to be in the target market for their product. And so we came up with the sweet spot approach and where you make an assumption. Yes, there might be 1 million or 2 million of this type of user in the country. What percentage of them are the sweet spot users? Are those that are your real buyers? And so in this case, in this example, it's saying 20%. 20% might sell a high-end home in a year and be totally, need this product. So in your spreadsheet, this is just adding in another column, an assumption for what is your assumption for the sweet spot? Maybe it's 50% based on the nuances of your market. But it's really important to think about, especially when you're doing a user-based approach, like what is the sweet spot for those? Because it's just not credible to say we're selling a product for nurses and every nurse in the country will sign up and use this product. Maybe, depending on what it is, but maybe not. So maybe it's only nurses in critical care units, or maybe it's, I'm not a nursing software expert either. So, but just to share that as an example. So, and then in this example, the global is here. So in this case, it's a $1.1 billion market, and that is a tough spot to be because it can feel like, yay, I'm over $1 billion, and seems like it would be easier to raise venture. And I think that what I've seen is when companies are around $1 billion, the very few, even fewer than normal, get funded, and the CEOs can spend a lot of time, like basically 6 months of CEO time chasing venture, which is a full-time process, and never really stand a chance of getting it because of market size. So I'm not trying to be a downer. I just want CEOs' time protected and used most strategically for the highest impact. So I have a few more slides to go through. How do you figure out your ideal segments? And then what for each business model, how do you address it? So a couple yes, no's, do you sell to more than one industry? If so, make sure every industry is on there. And ideally have it broken down by size. Are all users likely to use your product of that type? Yes, no. If not, then add the sweet spot logic. And then for breakdown of size, like what is the most relevant unit for your market? Is it number of stores, number of plants, locations, number of brands under management on your software, number of users? Like that matters a lot because it probably aligns to how you're either selling or should be selling your product. And then what would cause people to pay different amounts. There's been a couple of cases where people have done market sizing. If you're selling into only one existing ecosystem, so for instance, in the Salesforce ecosystem, there are quite a few companies that have built products that are selling only to Salesforce customers. 8 years ago, investors did not think that was a big enough market to invest in this single ecosystem product. Now in some cases they do. So the fundamental market sizing question is how many customers does that mothership company have? And from there, what percentage of them are a fit for you? So it's really, any ex-marketers on the call, any current ex-marketers on the call, you're going to do well in this process because it's really about thinking about your prospects. So, okay. Now, if you are what I'll call a traditional or horizontal SaaS company, where you can sell to multiple industries, really multiple industries, maybe lots of departments, like a wide range of users or companies, then I recommend coming up with, well, for everybody, coming up with as many different approaches to bottom-up market sizing as you can. So and then go out and see. So I would start by coming up with a list of, okay, God, ideally it would be by industry and by size. Okay, but then it would also be by locations. God, and I wish I could also find the information by number of users with these two job types. And so I come up with my fantasy wish list of all the miracle data I hope to be able to find. And I think through the logic of, like I said, the fantasy plan for doing market sizing. And then you go out and look for the data. And maybe you can only find data for 2 out of 3 or 2 out of 4. But great, you now have 2 different ways that you've done the bottoms up market sizing. And what I really recommend, especially for founders, is don't look at the answer. Like during this process, it's much more important about the assumptions. And I've done this before and been able to find data for 4 different ways of doing bottoms up market sizing for one company. And in multiple times I've been able to find data for 4 different logical approaches. And in one case, all 4 bottoms up market sizing approaches came to within $500 million of each other, $500 million of each other in market size, which gave me just as an investor a ton of confidence that this market really was that big no matter how I sliced it. That's happened a couple times. Another time, I was able to find data to do bottoms up market sizing 3 different ways. And 2 of the ways came out very similar. And the 3rd way came out drastically less. And it was a really good yellow flag. This is me with my investor hat on, that there was, ooh, what was going on here? And it was actually, a significant yellow flag that there was a structural issue with the market that basically that issue where they had a huge percentage of their market relying, assuming they'd be able to sell to 5 companies. So it was too dense in a major segment of the market. So it was doing the bottoms up market sizing multiple ways can help you both feel confident on the market size, but also see structural issues or opportunities within your market. This is all saying same thing. Now, if you're an enterprise SaaS company, I talked about this a little bit earlier, do the same thing, come up with as many approaches as you can, but then run each model that you can find data for twice, with that 1st year ACV assumption, and then again with a 3rd or 4th year ACV, knowing that your product is going to continue to mature, and you will be upselling and selling higher value products to your customers over time. Now, with enterprise SaaS companies, or you also, the thing you have to really look at is look at the market density. Are there enough companies in the segment to go sell to? This becomes extra important for vertical SaaS companies. There are some vertical SaaS companies that, and it doesn't, and if there's, I know of vertical SaaS companies who have a total number of companies they can sell to in the world between 200 and 500 companies. But once again, it doesn't mean it's a bad market. You just have to really understand the nuances of your market and its density, because it has ramifications for your product roadmap, customer success investment, things like that. I think that was the last slide. Yeah, so I am happy to spend the rest of the time answering questions.
Yes, and we have a few, so I will start from the top.
Okay.
Hi, Judy. So for a B2B platform that has stakeholders on the demand and supply side, how would you size the supply side?
Is it a marketplace? Sorry. Okay, say the question again.
Yeah. So for a B2B platform that has stakeholders on the demand and supply side, how would you size the supply side?
It really comes down to who would be paying for your product. If only one of those sides is the sides that you're actually selling to and paying you, then it's just those, and you have to make sure you get enough of the supply side. The supply side becomes sort of a cost of your business. If you really have a solution that you can sell to both sides, then you do the bottoms up market sizing representing and inclusive of both sides. It's which types of companies, teams, or departments would be writing you a check, and how much would that check be for each month.
Got it. Do you have go-to sources for getting database for bottom-up sizing?
Yes. So bls.gov. So I can pull it up real quick if you want. It's a kludgy site, but it's the Bureau of Labor and Statistics site. So like the census, but for businesses. That is a way to get a lot of information about companies by type or by industry and by size. From there, I also, depending on the market you're selling to, it's possible to get, there are specialty analyst firms, right? So forget, beyond the Gartners and the Forresters and the IDCs, there are a trade association. So there's a manufacturing trade association and manufacturing industry analysts that will do their own, get paid to do their own research and publish results. So that those are, same with e-commerce. E-commerce, there are a lot of specialty analysts. And of course, they all sell their research reports, and you don't really want to pay for a research report until you know it has the right answers. So that's hard to, exact information you need. And even then, broke founders don't pay for it. I don't either. So when you find, they often, the analysts though, will do press releases about the market sizing reports they do. So it really comes down to a lot of Google searches. And when you find the report, there'll be a teaser press release headline. Such and such analyst firm shows XYZ market is going to grow by this percent, by this amount. And it's just like, great, but you always want a few more numbers. So at least then you can isolate the who it is and which report you want access to. And then I just tell everybody to start putting out big asks to share the information, because you don't need the whole report, you just really want some specific information. So BLS.gov, other industry reports. If you're going after a market that already has a big incumbent, sometimes the big incumbent has already done research or paid for these analyst reports and already published it sometimes in their investor calls or their investor deck presentations, or especially if they're public, then you can get access to that information. Okay. Yeah, that's what I've got.
What is the best way to find data to inform how you should price your contracts ACV, and what is truly serviceable / how much white space exists?
So pricing and packaging is a whole big thing unto itself. What I can say, there are like 3 different parts there. So what I can say about pricing and how this part plays into the pricing and packaging is that at least it gives you information into the segments. We can then think about like, how much could a company that size pay? From this perspective, it's really about how much could and would they pay, total check size. It's not realistic to think a small firm that makes $1 million a year total is going to pay $100,000 for software. They're not going to. So it's about propensity and ability to pay. But for your pricing, well, there's so much to talk about on pricing. It's figuring out your pricing really comes down to like the value of your product, and at least from this perspective, the segments, and coming up with the right sized price and packages and additions for your target segments. So I know there are 2 other parts to that question.
Okay.
I lost my train of thought on the other 2 parts of the question.
I'm trying to find it. So how would you price your contracts, and what is truly serviceable, and how much white space exists?
So the serviceability, that's a good point. So white space, meaning like competitors don't already have them. They don't already have a solution. So the serviceability is also how you sort of give a nod to, there are competitors, and some maybe, in this case, 10% of the companies out there already use this incumbent solution, and they're never going to change. Like, let's just acknowledge they're never going to leave that. So while the other 90%, we can go fight for that market. Yeah, so it's this, this market sizing is more like you have to know some things about the market to do this. Yeah, I don't have it's not going to tell you, how much white space there is. You have to sort of know what the white space is, but you don't have to make your serviceability haircut so strict that it's only the white space, right? It's somebody can be using a competitor and they could still switch to you someday. So it's not, your market sizing doesn't have to reflect only the clean open white space.
Okay. So many questions. So could you say more about TAM to SAM? Very few SaaS command 90% of market share. Example, MailChimp has 60% of email. How do you think about the defensible rationale?
Perfect. And I'm so glad you asked, because this is something I really want to clarify. The market size and that serviceability isn't your forecast, isn't your company dream. It is not saying you're going to someday go win 90% of that market. This is separate from you and your company. This is the market. The market for, let's use the MailChimp example, email marketing solutions. How big is that market? How much will companies pay one or more email marketing companies? That's the market size. Now, how much MailChimp gets of that, or how much a different company gets of that, those are their numbers. So market size isn't your forecast, isn't your plan, isn't how much you're saying you will go get. It is truly just an analysis of the market you're selling into. And then one reason that the total market size matters so much is that if it is, say, a $1 billion market, think about it. In order to go public at a minimum 100 million ARR, that's saying you would have to have 10% of that market. And that's, just for early stage companies, it's a really far-fetched and unrealistic thing to say you're going to go get 10% of the market. Not saying companies don't over time, some don't get there, they do, but in the early stages, it's just not a safe bet to assume. So that's why you want a really big market, because then you can be successful in getting a smaller percentage of that market. So that's the difference. It's just a way of thinking, there's a market size different from how much of it you will get. And the bigger the market is, basically it gives you more room for error for yourself, because if that market is 10 billion, you only have to get a much smaller percentage of it to have a huge successful business by venture terms. Remember, there's lots of huge successful businesses by non-venture terms.
And then it'd also be helpful to hear how you view a growing market versus the current market.
Yeah. So where there's that clear, article about the market will be X big or growing by X%, then what you can do there, but say the data you get, the granular data is always backwards looking, right? So number of companies by industry and by size on the BLS.gov site is going to be from 2 years ago. You know what, I've looked at these enough, if you look at the data from last year's or 2 years, the most recent data you can find, if you go and look at the snapshot before then, yeah, the numbers go up and down a bit, but it's usually not significant. The number of companies in existence in the segment, those fluctuations are less meaningful. What's more interesting is the distribution of them across the segments. So where a company has a huge growth perspective and you can get the data based on, say, last year, the year before's, then you create your spreadsheet using that historical data and do that math, and then clone that spreadsheet and apply that growth rate, right? So if it's a 50% growth rate, great, apply that growth rate. And if you know it, if you know that more granular logic on where that growth is going to come from, certain segments, then apply it there, or just apply it. And so it's similar to doing the pricing today, pricing tomorrow. It's market size today, expected market size 5 years from now, 10 years from now. So I usually end up having 6 spreadsheets or sheets within the same spreadsheet.
Can you give an example of how you would come up with serviceable assumptions?
So US, if it's business software, in this day and age, everybody has internet. Everybody has mobile, everybody, there's Zoom info, there's all these inside you, there's all these business listing systems. You could easily just like I say, the global multiple for software is 3. Start with 90% as your default serviceability, and then just think about it. You can justify moving it up to 95, or if you just make it 80, great. Start with 90 as the placeholder, and no one will bat an eye at that either.
Okay, and what are your thoughts on the number of companies like Carta that aim to own close to 100% of small, tiny markets?
So in a case like Carta, where there's not really I don't know of a competitor, there might be competitors doing that. They plan to own one, and so it really comes down to how big is that small, tiny market, because they need to own 100% of it, right? If it's a small, tiny market, they have to own 100%. And if they don't have competitors, then there's a shot, and they can do a great job. Assuming they do a good job, they could do that. And then ultimately, because it's a small, tiny market, in order for them to continue to keep growing, think about it, once you own 100%, how do you keep growing? You have to keep adding new products and services to sell into your customer base in order to continue to grow. So, totally possible. I just don't know. Yeah, competitive situation.
Do you have any suggestions or insights about new categories and how they might impact the bottoms-up market sizing?
Like if somebody's thinking about an entirely new category of software?
I believe so.
So if it's an entirely new category of software, all the more reason why you have to do bottoms up, because there's going to be no top-down analysis for you. And no, I've done it many times for brand new categories of software. And in quite a few cases, it's because the founder's explaining, I can quickly understand it's a new category, and then they're saying, oh, and it's huge. I'm like, really? How is this? And so it's easy for investors to be like, how has this whole market been right here, untouched, up until now, right? So then the default assumption is, well, it must be small. So you have to do the spreadsheet and break it out to help make it real. I've done this one company. I was like, holy shit, how did you find an $11 billion market in the middle of all this noise? And it really is, and it's new, and it's just, there was no solution, but but it took a lot of work to get all that data. But when you do the work, you have the confidence, and the question just goes away. Investors they shut up. Like, it's the number one thing I hear from women founders after they've done this work. They're like, I used to get that question all the time. And now I show them this slide and they shut up and they move on. And they're just like, oh, got it, done. And so it's a way of, when it's appropriate, taking the question off the table in a good way, because it's like, oh, check, good.
Could you discuss SaaS multiples at exit before and during COVID?
So multiples is a whole different thing than market sizes, right? Multiples are about valuations of the company at exits. So no, I'm not prepared I don't have any organized thoughts on it, other than I would assume they have gone down because it's now a buyer's market.
And how does market sizing differ from forecasting?
Yeah, perfect. So market sizing is about the market. And once again, it's really not personal, because it's not about you or your ability to sell. It's not about you. It's not about your company's ability to execute at all. It's just about how many people in the world, how many companies in the world need this product and would pay for it. And they might all buy it from your competitor. So that's how little it's about you. Now your forecast is all about you, and your bottoms up look at which deals you think you will be able to close and when. So your forecast is about your sales pipeline and your ability to accurately assess how much of those deals you think will really close and when.
Okay, and I'm looking for the last question. Some of these questions are really dense, and I know we have 3 minutes left. On the bottom of slide, can you cite the appropriate density that is needed for sizing? In the beginning of the block, you mentioned that density within the market was a market flaw and a yellow flag. How do you reconcile the role of density in bottoms up sizing?
Just going to go to that slide. So it is, density doesn't have to be a flaw. It is just a really important thing to know about your market structure. Because, like I said, Viva, vertical SaaS company, started off selling to pharmaceutical companies. There are only a few hundred pharmaceutical companies in the world, right? But it's a big market and they have thousands of sales reps each. So it's more just an important thing to know the density of your market. I felt a little bamboozled because I didn't pick up on it right away, but it was like understanding like the market's this big, this much is spent, right? It was more of a tops down. This much is spent, they would spend this % on us, therefore our market is ginormous. And when I got into it, it wasn't even 200, I want to say it was like 10 companies represented more than half of their market. And so think about it, it's just not, it makes, in that case, 10. It's great if you really can win all those 10 companies and they pay you what you want and you keep them happy forever. But at some point, if your company's paying so many millions of dollars a year, they're going to build a solution themselves. Or if a company is, or heaven forbid, you lose a customer. You lose a customer, one of your 10, you're not getting that customer back for a long time. So now your market has just shrunk significantly. So so density is just something you have to really think about and understand, and make sure you have the right product and customer success strategy for.
All right, thank you so much, Judy. We're right around at time. So thank you everyone for all your questions. I hope that most of them were answered. For those latecomers, this session has been recorded and will be up on the AllRaise site no later than Monday. So thank you again, Judy, for your time and your insights and your nuggets. This has been very, very helpful. And then for everyone else, we'll be sending out a post survey at the end of this. Within the next 10 minutes, we ask that you please send us feedback. We would love to continue offering helpful and insightful events, but we need to know what you all want. So please fill it out. We'd really appreciate it. It takes no more than 1 minute. And thank you everyone for your time. And thank you, Judy, so much for gracing us with your presence.
Oh, well, I just want everyone to be confident in this because it can shut up a lot of people.
Yes. So a lot of great thank yous from the audience. So thank you again, everyone. We hope you have a great day. And please check out the AllRaise website on Monday. We will have the recording up with the session slides also part of the recording. So thank you all. Have a great one. And see you at our next event.
Awesome. Thank you.
Yes. Thank you, Judy.
Bye.
Bye.